This is Think Smart with TMFG, a weekly podcast of what's newsworthy and relevant to everyday Canadians. I'm your host, Senior Financial Advisor Mike Connon of CI Asante Wealth Management. Welcome to Think Smart with TMFG. I'm Mike Connon. This is Carlo Cancino, Senior Financial Advisor with CI Asante Wealth Management. Carlo, when you file your tax, do you usually feel you're in control or feel like there's just a big mess going on?
And that's a real concern for Canadians, Mike, because every year people are either overpaying, they're missing deductions, or getting surprised by a tax bill that they didn't expect. And most of the time, it's not because they did anything intentionally, it's just the small stuff that they didn't know to look for. So today, let's discuss the essentials for the 2026 tax season, like filing deadlines, common deductions and credits, tips for those who are self-employed, RRSP strategies, and the usual mistakes we have seen as financial advisors that can cost people money if you're not careful.
Carlo, how do you do your taxes and when? Personally, it's the most stressful. I do it on a weekend, and I do it on a weekend. It's the most stressful weekend of my life. Like in my year, I will put down the weekend I do taxes is my most stressed and least look forward to weekend of the entire year.
Remember, Mike, you have that dual citizenship. So then that I can understand why it is stressful. Yeah, no, I typically take a weekend to do it, but I'm relatively simple. My wife and I, we have our T4 income, some RSP contributions, charitable donations, fairly simple things. If you're taking all your slips and being organized, it's not that big of a deal.
Yeah, I have a lot of expenses. Yeah. And the problem is the expenses. For a lot of stuff, there's great tools out there now. For a lot of the company, I use something called HubDoc, which is a great tool. And HubDoc is something where you take a picture of your receipt, and it goes and automatically goes and keeps track of that, and you can put that into your spreadsheets or whatever accountant program you use. And that works very well, but there's a bunch of other stuff that I have personally that is deductible too. And I use the shoebox method, which is probably a horrible method, which creates all that stress at the year end because I'm going through this box of receipts. And the paper they put them on is almost like, it's like from when you used to watch those Get Smart where things just self-destruct.
Yes.
The paper that receipts come on, they all self-destruct. And by the time you get 3 months later, I don't know what happens to them, but they crumble up and all the...
they start to
and all the ink starts to go to zero, and you're trying to read what restaurant it's from and what day, and
Let's not forget about, and if you could see that out there, if our audience could see it, Mike has this wallet, and it's massive.
Because George Costanza.
It's the Costanza wallet. He's got all these receipts in it that don't make it into the shoebox, and that's why I think you maybe have back problems, because you're sitting on a big fat wallet.
What we're here today to do is try to make sure you guys don't have to go through the same stress that I go through.
Exactly.
Let's talk about what type of forms you get, deadlines, and different things like that. It's funny because taxes have become easier and easier because, on one hand, because most of the stuff Revenue Canada has. Now when you download a tax program, every now and then I meet with people that don't use tax program. It blows my mind that the tax programs are essentially, there's ones out there for free now that are very good. I think even the government is offering a free program. You no longer really have to pay for the software. Some people do. You can use your TurboTax or whatever, but it's getting to the point where you can get almost free software now. And the great part about the software, it can actually go in and download all the information that Revenue Canada has. Again, when you used to go and have to enter all these slips, now it gets downloaded, which is very handy.
Yeah, no, it's getting much easier to complete taxes on your own. If you have a fairly simple tax situation, like you're saying, Mike, if you register with a CRA and have that online account and you have a qualified software that you're using, all of that information just gets pre-filled.
It's great. You might think I'm going in the direction where I'm saying I'm suggesting you do it on your own. No, that's not really the suggestion. What the government knows is everything that's in the government's advantage.
Right.
The government's made sure that everything that costs you more in tax is on file. Everything that saves you money in tax is unfortunately not on file.
Right. That's your responsibility.
So if you go and you leave this up to just the government to tell you what you're owed, you're going to owe the most taxes possible in your situation. The reason for doing your tax return and putting a lot of time into it or hiring a professional to do it is because you want to reduce the amount of tax that the government that you're going to have to pay to the government. Let's start with some of the forms. These are the common forms that people have. Number one, you have your work. You have your T4s.
Right.
T4s are going to be if you're working, that's what your employer is going to give. There's a bunch of T4s with different things after them. They're usually just income. There will be, if you're retired and you're receiving RIF income, you're going to get T4 or RIF. And generally speaking, these T4 slips are due around the end of February.
Yes.
In there. Then you get to investments, and investments can have different forms of slips. There's T3s and T5s. T3s generally come up from mutual funds and things like that. T5s can come up from stocks.
Exactly.
Stocks are generally pretty simple. They're required out by the end of February. T3s, mutual fund or any type of investment like that, generally a trust. So it's almost a trust return they have to file and has to be audited and accounted for. Generally speaking, when you look at T3s, they're going to have a later deadline. They're usually the end of March. Most companies do a pretty good job getting them out before that time, but that's when they're required out by.
If you are a mutual fund investor and want to file your taxes early, we'd suggest holding off until you get those T3s, because if you do end up filing your taxes and forget to add in those T3s, obviously the government does have them on file, but they are going to be later than what you'd expect if you want to be filing your taxes early.
Then there's some new forms now that we have that have been the last few years called T5008s. Now, what they do is they keep track of all the capital gains that happen in your investment accounts. Previous to this, T5 used to be responsible for calculating your own capital gains.
Yes.
It was a lot of work, and a lot of people didn't really do it well and nearly didn't do it at all. And it was in your advantage not to do it because the government never got their dollar. Right. Unless you got audited, you'd have problems in there. Right. So the government made a rule a few years ago that requires financial institutions to keep track of gains and losses. And what happens, you receive a T5008 form, and that will go take care of that stuff.
Yeah, a suggestion we'd make is as your tax slips come in, maybe have a checklist of what you're expecting from previous tax years. As they come in, keep them organized, keep them in a folder so that you can, when essentially you received all your slips, that's when you know you can file your taxes. Just being organized really helps when it comes to filing on your own. But if you are using a tax professional, filing them together and giving them to your accountant or tax preparer in one package, helpful as well.
The other thing that just puts to softwares and professionals is we have income split among seniors, and there is no one that can do a better job than a program on that, or having a tax professional use a program to realize how to go and split your income. That's an important thing to know when you're doing that. Other general rules we have in Canada, a few things that we want to put as points. This is like tax planning 101, but Canada has a progressive tax system, which means we have marginal tax rates. Everyone has a personal exemption. I think it's somewhere around 15,000.
15 to 16,000.
Then after that, you're going to be in a low tax rate, somewhere around 20% range.
Yes.
And that goes up to somewhere around, I think, mid 50,000 range.
Yeah, exactly.
Then you start to go up to the 30% tax range. And that goes up to around somewhere around the 100,000 or so range. And then it goes up 40. And then we start to get in the higher tax rates. We max out at about 54%.
Yeah, just under the 54%.
You got to know that when you're filing, because that's a big piece of write-offs and how you want to split income, because you want to work those marginal tax rates.
Understanding what your marginal tax rate is, given all of your income, will help with your tax planning. Understanding what your deductions are, how much you should be contributing to an RSP. If you don't have the cash to do, many people use the flexibility of a tax-free savings account to help make RSP contributions. But again, understanding where your income is and what marginal tax bracket you fall into, you can help reduce that and get, I don't like to say it, but the most bang for your buck when you're making RSP contributions.
And the other thing is all incomes are not taxed the same. And you got to remember there's different types of taxation on different incomes. You have employment income, which is just taxed at the marginal tax rate.
Yes.
Then you can go into dividend income.
Yes.
And again, dividend income is going to be, they gross it up on the tax return.
Yes.
And then they give you a dividend tax credit to help offset that taxes. It ends up being taxed at a lower tax rate. But again, you got to be very careful with dividend income because there's two pieces of your tax return. There's where you calculate OAS clawbacks and things like that.
Right.
And dividend income, a weird thing, it might be taxed better than, let's say, interest income. But for OAS clawback purposes, it gets grossed up. It can actually have more of a negative effect on OAS clawback.
Yes.
Then you have income that is capital gains income. And capital gains, again, is taxed at 1/2 your income. And so that's handy. But again, you got to watch that on where it shows up in your tax return.
Yes.
You think if you have to have capital gains and capital losses, that would be a good thing. They offset each other.
Right.
From a tax point of view, they do. But from an OAS clawback standpoint, they don't, because it's on a line below where they calculate the OAS clawbacks.
Yeah. And what you'll find with a lot of the income tested benefits that you get from the government, they're on your net income versus your taxable income. And I think, Mike, that's what we're talking about, because you're going to have your total income, and that's just a total of all the different income sources. But after the deductions like RSP contributions and the other deductions that you have, you get your net income. And that's where you will get those income tested benefits either clawed back or you remain under. It's the taxable income that we're worried about when it comes to understanding what your tax bill is going to be.
So now we begin to see why people hire professionals to do taxes.
Exactly.
This 101 has just added a step further in
I think
complications.
We're 201. We don't want to get into 201.
Yeah, it goes pretty quick.
Okay.
Let's talk about deductions and credits Canadians have.
Yes.
So that's another thing that we want to make sure that people have and don't miss. Give us an example of some things that are commonly overlooked.
Sure. Let's talk about first the difference between deductions and credits, because I think that's something that many people get confused. A deduction is essentially reducing your taxable income or the income that would be used to calculate your taxes. A credit is direct payment or of taxes payable. We need to understand the difference between the two.
Yeah, they're very different. And again, especially when you get into marginal tax rates and clawbacks and all that stuff, the deductions help that and the credits don't. You got to be really careful on what you're dealing with there. A lot of times, the one great thing about how we've charged fees over the years is we always separate the fees on the open account.
Exactly.
The reason why we do that, it's a deduction, which is a huge help because it comes early on in the tax return, straight off the income. Other things that you do, people do charitable donations and things like that, and they believe that, okay, I'm going to get rid of my OA's clawbacks. That's not going to do it. That's a tax credit.
But yeah, to your point, Mike, it's up to the taxpayer to keep track of all of the things that they do that could help with non-refundable tax credits. If you're making donations, you want to make sure that you're tracking what those are because you get a non-refundable tax credit for it. Medical expenses. If you are paying out of pocket for medical expenses, if they're qualified, you can get a tax credit for it.
And one thing to people, get receipts on this.
Yeah.
You wouldn't believe how many people go and say, I'm getting care for my family members and I paid them cash. And I go, can I deduct it? Go, no. You need to have receipts. You need to have the social insurance number. You need to have something that shows you paid it to them. And again, what happens is you miss out on that deduction. You can pay them 20, 30% more. It's the same thing if you're getting the deduction for it, right? So it helps out to have that situation there. Tuitions for kids. And then again, where to put that? Does it belong on your kid's tax return? What part of it can be carried over to your own tax return? How does that work?
Yeah. Also, childcare expenses. If you are a young family and there are expenses to be paid, what can't be deducted against your income may qualify as a childcare expense for the tax credit.
And every year there's new things. I know there's a bunch of things about home renovations, things like that. There's credits along that way. There's if you move closer to your work, you can get deductions for the move. There's certain criteria that you have to hit to do this. But again, you're seeing why sometimes a professional is a real necessity in here.
Exactly. Mike, do you want to move on to, we talked about personal tax filing. Do you want to talk a little bit about self-employed and what that looks like?
Self-employed, we always talk about self-employed versus corporations. They should be about equal from a tax point of view. But with self-employed, you really have to keep track of all your expenses. And you can deduct any expenses that are affiliated with earning income directly into that. So you can definitely do that. But you got to really, the better notes you keep, the better. If you have a receipt and you went out for dinner, put out who you went for and what the purpose was. If you're driving and you're using your car, keep a log, keep track of what it is. The more evidence you have for this, the more clear these expenses are going to be. And again, this is another thing, I can't say this enough. Once you get into this, it's time to have a professional. Professionals know when you're pushing the rules too far. At a point, you might have a home office. What percentage of your house expenses, which parts of that can you write off? And if you go too far, you're going to put up some flags. And if you start those flags going, you're going to be in a nightmare. So it's key to have someone that does this all the time and they know, okay, here's where I'm going. This won't trigger anything. And these are reasonable deductions. It's fair. And we're going to save that money. And we're not going to push us to the point where it causes problems in the future.
No, you're right. And that's just another reason why keeping good records, being organized when it comes to filing income with the CRA, because again, if that red flag is up, you end up being on that list for a long time, and you definitely don't want to have to walk through that audit experience if you don't have the backup to show what you were claiming.
Let's go to another thing that always confuses people. Our part of the thing, doing RSP contributions. Now, it becomes second nature for us because we do this all the time. That's all our career has been built on taking RSP contributions from people. A few things that are very odd about RSPs. Number one, your room is based on the previous years. Your 2025 room is based on your 2024 income. It's fallen a year back, which confuses everyone. The other real key is January and February, which confuse everyone because January and February is now in 2026. Any contributions you use in January and February can be used against your 2025 tax return. The reason being is the government realized that no one knows really the final finality of what they make. They said, let me give them another 2 months to figure all that out, see what they made for last year, and they can figure out how much they have to contribute to make that work. But the tricky part is in January and February, you have the choice to use those contributions either for the previous years.
Right.
Now we can use the 26 contributions for 2025.
Yes.
Or you can use it for 2026. So you have the room in there. That always creates confusion because some people are really ahead of the game and put it in January for that year.
Yes.
Because as of January, you can do contributions for 2026.
Correct.
If everyone has unlimited amounts of money and you want to do the best thing from a financial planning January 1st, if you know how much you made last year, you know what your limit's going to be, you can drop that money in right away. It's
Absolutely.
working for you on a tax-free basis from January 1st. But most people don't do that.
No. No. And having that extra cash flow to do so can be difficult for many people. But understanding what your contribution limit is very important because we talked about the marginal tax credits before, marginal tax rates. You may have a lot of RSP contribution room, but you may not necessarily need to use all of that contribution room in 1 year. You may be strategic in only contributing a certain amount to help for that previous tax year.
Yeah, if you're making, let's say, $60,000 in a year, does it make sense to do a $30,000 contribution?
Definitely not.
Probably not, because you're going to be writing off a very low tax bracket. You're better off using that over years to work that tax bracket down. Again, and people, you have to take into consideration pensions, what your pension income is going to be to see if it makes sense. The idea of RSP contributions, you're always trying to move money from a higher tax bracket to a lower tax bracket in the future. And you got to make sure you're accomplishing that. And our advice is not always just maximize your RSP. Sometimes it goes very different. Again, as we talked about needing a tax professional, you also need a financial advisor to work that stuff and understand all your marginal tax rates throughout your life.
Yes. We often hear from people as a blanket statement, RSPs are bad because you have to pull out that money and you're taxed on it. But Mike made a great point that the concept of it makes sense. You're making the RSP contribution when your tax rate is high. And when you're pulling out of the RSP, it's typically at a period when your tax rate is low.
Yeah. And the other thing people forget about is once you make that contribution, you have the money in hand that you save. That's
exactly.
One thing. I see all those calculations say RSPs are a bad idea.
Yeah.
They never take into account that you actually have the money in your hand.
Yeah, immediately. Yes.
For 10 years, you have that money working for you. Yeah. And the trick is to keep that money working for you.
Of course.
There's other few weird things like there's a $2,000 over contribution room. And that's really the government put out there just to make sure people don't have to be to the dime. It really doesn't have much of a use other than that. It just means that if you're over by a bit, they're not going to penalize you. They can't actually write off the amount you're over. It's not going to help you from a deduction point of view, but it means they're not setting penalties because the penalties are pretty harsh once you're over.
Yes.
I think they're 1% a month.
1% per month over the contribution.
Yes, you definitely want to be over.
Yeah. And strategically, you can be using that over contribution room. Now, it may not be a recommended strategy that we suggest, but if you are over, that is an additional $2,000 that you have growing tax deferred.
Let me give you a recap of everything we covered because we covered a lot of stuff today.
Yeah.
Number one is just key filing dates. Know where they are.
Yep.
Make sure you have all your slips together before you file. Don't be rushing out before everything comes in because it's going to be more confusing than you thought. Really understand what counts as taxable income. Understand those progressive tax rates. Check for deductions. Make sure they're all in place. Make sure you've taken everything into account. Ask your professional what you're able to deduct. And remember, you can even transfer, if you're taking care of your mother and she's disabled and she is a low income, you can transfer those credits to yourself. There's a lot of stuff you need to know in there. If you're self-employed, clear records.
Yes.
And make sure you're strategic with your RSP contributions on how you do them.
Yeah, no, I think it's important for us to note that you're not going to get everything perfect. But what we've talked about, these steps can help give you more control and peace of mind. I think it's normal to feel unsure of what you're doing, and that's why we do recommend using a tax professional. But I think the most important thing is to stay informed and stay organized so you do all the right things. You don't feel like you're scrambling.
Thank you very much, Carlo. That brings us to the end of another episode of Think Smart with TMFG. Thank you for listening to the Think Smart podcast. I'm Mike Connon with the McClellan Financial Group of CI Asante Wealth Management. Don't forget to subscribe to Podbean, Apple Podcasts, Spotify, or YouTube, and leave us a review. For more insights and resources, visit tmfg.ca or follow the link in the episode description.